staring directly at the data, reveals something fundamentally broken beneath the surface. Not the theatrical breaking that fills headlines with contradictory analyst opinions before lunch ends, but the silent structural fracture invisible until the building announces what the foundation already understood. Gold sits at 2,198 at Western spot. China returned online following Lunar New Year celebrations. The first signal emerging from ground level, not analyst reports, not New York futures desks, but the actual physical retail network spanning multiple gold shops nationwide, tells a story more significant than price negotiations, delivery delays, or managed backlogs. Sellers are returning money. Contracts signed before the holiday receive outright refunds. Not rescheduled fulfillment dates, not waitlist placements, complete refunds. When sellers cannot source physical metal and choose returning cash over fulfilling committed orders, that transcends supply hiccups managed through conventional channels. That represents physical delivery failure expressing itself in the clearest, most direct market language possible. Happening right now, real time, in the world's largest gold-consuming nation, precisely when spot price holds at $2,198. Understanding this requires full context, because context defines everything here. Throughout Lunar New Year, China remained essentially offline. Conventional analytical frameworks applied by most market commentators and desk strategists predicted that without China's demand engine running full capacity, metals would face downward pressure. That consensus logic positioned portfolios and framed narratives heading into the holiday period. Instead, gold held, absorbed a Supreme Court tariff ruling, absorbed sustained policy uncertainty, absorbed a dollar relief bounce that under normal circumstances would have applied meaningful pressure to the metal, never broke, never flinched at critical levels. Now China operates fully. The first ground-level market signal indicates inability to source metal for its own customers. Those following this analysis consistently already recognize this outcome embedded in demand data before Lunar New Year even began. The physical supply picture surprised nobody reading primary data rather than awaiting mainstream confirmation. Newcomers should stay close through everything revealed here because what unfolds across the next several minutes will permanently transform how these markets are read. Not through opinion, but through the numbers themselves. What makes this particular moment genuinely unusual demands precision, because precision separates analysis from noise. The physical shortage now expressing through contract refunds across Chinese gold shops arrives not into calm, stable markets with low background volatility. It arrives into markets where gold volatility just hit its highest level since the global financial crisis. That represents no background detail to note and move past. That is the market's forward-looking mechanism actively pricing tail risks not yet fully materialized in public data, but already visible in structural indicators to anyone willing to read the numbers properly. When volatility spikes to crisis-era levels, while price simultaneously holds and advances rather than collapsing, the market processes something real, something not yet appearing in evening news cycles, something already written into price architecture itself, waiting for the event, giving mainstream media a narrative to attach to what data has been saying for weeks. If gold represents the story most people partially track, silver represents the story almost nobody connected yet. Managed money long positions in CME silver contracts, the speculative funds, momentum-driven capital, systematic traders chasing and amplifying directional moves in both directions, sit at their lowest level in 20 years. Not their lowest level this cycle, not their lowest since the last correction, their lowest level across 2 full decades, lower than depths recorded during the 2008 financial crisis, lower than every washout, every capitulation event, every moment of maximum fear and forced liquidation this market passed through across 20 years of cycles. The speculative infrastructure normally accompanying large silver moves is essentially absent. Yet silver just moved 16% off its weekly lows, 16% without momentum capital, without the speculative crowd typically fueling that kind of move, without the managed money positioning historically accompanying a 16% weekly advance in this market. Hold that combination carefully because that connection returns with precise explanation for what it means for the next phase of this move. First, though, the structural layer sitting underneath everything observed in gold and silver requires examination. Neither market exists in isolation. They connect to a much larger shift in global monetary architecture that has been building for years. This week's data made that connection impossible for honest analysts to ignore. The US dollar's share of global foreign exchange reserves just hit its lowest level in 32 years, 56.9%. That number represents decline from 72% at the peak of dollar dominance. Consider the magnitude of that shift across reserve management decisions of sovereign institutions worldwide. Central banks reduce dollar exposure not because they read newsletters. They make no politically motivated statements. They fulfill fiduciary obligations to sovereign balance sheets they manage. The arithmetic of U.S. debt trajectories, structural deficits carrying no credible reversal path, and long-term institutional credibility erosion has made diversification shift arithmetically unavoidable. This represents no political argument. This is reserve management decision made consistently, quietly, and in increasing volume by institutions whose job protects national wealth across multi-decade timeframes. Meanwhile, investor and central bank demand for gold averaged approximately 610 tons per quarter over the last 2 quarters. The historical threshold associated with roughly 3% quarterly price appreciation sits at approximately 380 tons. Current demand run rate exceeds that threshold by 230 tons per quarter. No mystery exists in gold trading at 2,898. No hidden variable requires complex explanation. Documented verifiable demand running well above historical trigger points for price acceleration meets a physical supply structure demonstrably unable to fulfill it. The refunded contracts in China represent no anomaly. They are visible surface expression of supply-demand imbalance that data already made legible weeks ago. Something most people watching this market still haven't connected requires proper explanation because the implications change the entire risk picture for everything discussed so far. A $2 trillion private credit market has been quietly funding the AI infrastructure build-out over recent years. Not the publicly traded technology companies making earnings call headlines. The physical infrastructure layer beneath them, data centers, computing capacity, power infrastructure, the physical backbone artificial intelligence waves require to actually function at scale. One key lender operating inside that system manages approximately $273 billion in assets. It recently restricted withdrawals from a $14 billion retail fund. When a fund of that size restricts withdrawals from a retail vehicle, the immediate market question is straightforward. Does this fund possess sufficient liquid assets to meet obligations as they come due? Companies borrowing inside the system carry extreme debt loads to build infrastructure operating on timelines where meaningful cash returns may not materialize for years. Revenue projections supporting those debt structures depend entirely on AI adoption timelines and commercial magnitude not yet confirmed by actual operating cash flow. They are projections built on projections, levered to timelines not yet proven. If those revenue timelines disappoint, not catastrophically collapse, just disappoint modestly relative to projections embedded in debt structures, the stress doesn't remain contained inside technology sector earnings misses. It migrates into credit. Private credit is no niche corner of specialized markets. It is $2 trillion of pension capital, insurance capital, and institutional money deployed into illiquid structures that cannot be quickly or cleanly exited when conditions deteriorate. The withdrawal restriction on a single $14 billion fund is not the crisis. It is the early signal of where stress inside that system first becomes visible to the outside world. Hold that signal alongside what simultaneously happens in the U.S. housing market. The pending home sales index just printed an all-time low, down over 43% from its peak. Contract closings falling more than 8% in a single month. The housing market isn't softening. It isn't in managed slowdown, it is frozen. Activity at levels having no historical precedent in the data series, and it freezes at precisely the same moment a $2 trillion private credit structure shows early withdrawal restriction signals. Gold volatility runs at levels not recorded since the last major systemic event, and physical gold supply in the world's largest consuming market cannot fulfill delivery contracts. Robert Shiller wrote extensively in Irrational Exuberance about how markets reprice risk assets before the broader public recognizes that a shift occurred. The repricing happens first in instruments closest to the risk. Then it radiates outward. We are watching that repricing happen in real time in gold and silver while mainstream financial commentary still constructs narratives around tariff noise and policy uncertainty. The mechanism Shiller described is no theory. It is documented pattern, and the pattern is currently active in the data. Something deserves direct address because previous comments raised it clearly enough to warrant proper answer on its own terms. Technical analysis, whether it matters, whether it belongs in the same conversation as fundamental data, just examined. The honest answer is that someone arguing technical analysis doesn't matter for long-term investors is not entirely wrong. If your time frame measures in years rather than months, the fundamental thesis absorbs significant amounts of noise that shorter-term price action generates. Pure fundamentals can carry long-term positions through great deals of volatility without requiring refined technical systems. But here is what that framing misses. Serious long-term capital, money with genuine institutional conviction behind it, still runs sophisticated technical systems alongside fundamental analysis. Not because fundamental thesis holds any uncertainty, but because knowing precisely when to add size and when to wait for better structure is its own independent edge that compounds over time. Meaningful and quantifiable difference exists between being directionally correct and being optimally positioned for timing of moves. For anyone operating on shorter time frames without technical analysis, the disadvantage isn't marginal, it is structural. You make timing decisions with no framework for reading information that price action itself broadcasts. The combination produces highest conviction positions. Fundamentals define what, technicals define when. When those two layers align simultaneously, when structural deficit thesis meets specific technical price structure at precisely defined moments, resulting conviction is genuinely unshakable. Nobody can talk you out of positions you understand completely from both angles simultaneously. Building that level of analytical clarity takes time and genuine desire to learn, but with consistent effort, 6 to 12 months suffices to develop working command of both layers. That timeline has been confirmed repeatedly by people who showed up to this material knowing almost nothing, and built real analytical skill through consistent engagement with the data. Something specific about technical analysis connects directly to what silver has been doing over recent weeks because it illustrates practical application more clearly than any abstract explanation. Price action has memory. Patterns repeat consistently in markets, not randomly, not occasionally, but at specific times during specific sessions, on specific days of the week, during specific weeks inside monthly cycles. That repetition is no coincidence and no mysticism. Whether you label it algorithmic behavior, institutional positioning cycles, or systematic market structure, the label doesn't change observable reality that these patterns are consistent, documentable, and usable once you've spent enough time learning where to look and what to look for. People who identified the bullish swing failure pattern forming at $72 in silver, who marked the inverse head and shoulder structure before it fully played out, used that technical information to position themselves before the move confirmed. They weren't reading headlines in that moment. They were reading the structure of price itself, and the structure was broadcasting a completely different story from what every mainstream commentator was constructing around the same data. The bearish case deserves proper presentation without dismissal because intellectual honesty is the only thing giving this analysis lasting credibility. And the audience building here deserves having the counter-argument presented seriously rather than used as prop to dismiss. Gold at $2,198 with volatility running at its highest level. Since the global financial crisis means sharp, fast, deep pullbacks can materialize at any moment without any change in underlying fundamental picture. Elevated volatility markets are markets where large directional moves occur in both directions at higher frequency and magnitude than low volatility environments. The same energy structure driving a 5% advance can produce a 7% reversal within days. Both moves can happen inside intact long-term bull thesis. Silver moving 16% off its weekly lows has created meaningful inventory of short-term participants sitting on recent gains who will exit into any credible negative headline. That exit pressure in markets with thin liquidity windows can be substantial and fast. The private credit stress, while visible in early indicators, has not yet produced publicly visible headline-level bankruptcy or default event. Until it does, institutional capital allocation committees may maintain risk asset exposure rather than accelerating rotation into metals. The system has documented capacity to carry visible early stress signals for extended periods before those signals resolve into actual market events. Jim Rogers documented this dynamic in detail. Commodity bull markets produce violent corrections that shake out the impatient even when multi-year structural thesis remains entirely intact. Silver dropping from higher levels to lower levels and still closing green on monthly candles is exactly that dynamic expressed in live market data. The structure held, the thesis held. Most participants' conviction did not. That is real risk for anyone entering this market with incomplete analytical preparation. Here's what the counterweight to that case looks like when examining the full data picture. Gold has outperformed the S&P 500 on every major time frame examined. 1 year, 5 years, 10 years, 25 years, every single one without exception. The mainstream financial advisory industry largely behaves as though this performance record doesn't exist in publicly available data. That is no analytical oversight made by people who simply haven't looked at the numbers. That is structural conflict of interest embedded in how advisory compensation is constructed and how institutional product distribution is organized, and it systematically delays flows into metals in ways that eventually produce accelerated compressed repricing when those flows finally do arrive. Silver miners currently sit only 14% from their all-time equity highs, while spot silver itself remains 44% below its own nominal price peak. That divergence between where equity market prices future metal prices and where spot metal currently trades is an intermarket signal with specific meaning. Equity markets are forward-looking instruments pricing outcomes not yet fully expressed in spot prices. When mining equities approach all-time highs while spot lags by 44%, the equity market tells you something about what it expects physical price to do. That signal doesn't resolve by mining equities declining to meet spot. It resolves by spot advancing to close the gap. Then there is this number, and you need to sit with it fully before moving past it. The silver market has now printed 10 consecutive green monthly candles, an all-time record in the data series. Understand what that means in terms of what had to happen to produce it. Coordinated, sustained selling pressure brought silver down through multiple sessions of significant forced selling. At the close of each month across 10 consecutive months, the physical demand sitting underneath this market absorbed every single unit of that selling pressure and still closed the candle in positive territory. What level of structural physical demand has to be present to absorb forced selling and still produce green monthly closes? That number isn't small. It isn't marginal. And it doesn't appear in paper market positioning data because paper positioning doesn't measure physical absorption capacity. Return now to where promised earlier, the speculative positioning in silver and what it means for the next phase of this move, because this is the layer the informed minority already understands and the majority hasn't yet connected. Managed money in CME silver is at 20-year lows, below the 2008 crisis, below every capitulation event in 2 decades. Silver just printed a 16% move off its weekly lows without that capital present. When momentum capital eventually recognizes this market is moving, and momentum capital by mechanical definition of what it is and how it operates eventually chases momentum, it doesn't arrive gradually through cautious incremental positioning. It arrives in size, it arrives quickly, and it arrives into a market that already moved 16% without it. Picture that. 20-year low speculative infrastructure against a physical supply backdrop in the world's largest consuming country, where sellers are refunding contracts rather than sourcing metal. The move that already happened will look like the opening sequence of the full move when that capital rotation occurs. That is no prediction. It is arithmetic of positioning dynamics applied to current structure of this market. Taken together, here is what the complete data picture says simultaneously. Physical gold shops in China are refunding contracts rather than sourcing metal, a delivery failure in real time, not a forecast. The dollar's share of global reserves has hit a 32-year low at 56.9%, down from 72% at peak, with central banks actively reducing exposure through documented reserve management decisions. Silver speculative long positioning is at a 20-year low, even as the market prints a 16% weekly move and extends an all-time record of 10 consecutive green monthly candles. A $2 trillion private credit market funding AI infrastructure shows early withdrawal restriction signals in a $14 billion retail fund managed by a firm with $273 billion in assets under management. The U.S. pending home sales index has hit an all-time low, down 43% from peak, with contract closings falling more than 8% in a single month. Gold volatility runs at its highest level since the global financial crisis, which is the market's forward-looking mechanism, pricing tail risks already visible in structural data. These are not separate stories. They are not parallel developments in unconnected markets. They are the same underlying story expressing itself simultaneously across different asset classes, all pointing in the same structural direction at the same time. The question to keep returning to as sitting with this data and leaving it with you because it has no clean resolution is this. If physical supply is failing delivery at the world's largest consumption point, if the dollar's reserve roll is at its weakest position in 3 decades, if speculative positioning in silver is at a generational low, while the metal sets consecutive monthly gain records, and if $2 trillion in private credit begins showing earliest visible stress signals at the same moment the U.S. housing market freezes to an all-time activity low, what exactly is mainstream financial media waiting to see before it changes the narrative it currently constructs? That is not rhetorical. It is diagnostic. The answer to that question tells you more about how institutional information flow actually works than any individual data point in this analysis. The community being built here is not built on followers. It is built on thinkers. Thinkers always leave a mark. The data already spoke. Invest with logic, never with noise.